welcome back. It's good to see you.
Good to see you, Scott and crew.
Will you admit that you've been too bullish on stocks?
Yes. I'd say that our base case for this first half of this year was stocks would be treacherous, but it's been far worse than we expected. I mean, if I look back at first half 2022, it looks like, as Josh is describing, the market is really bent. I mean, especially economic expectations towards a recession. That was not something we expected. So it's been a far deeper correction than we thought possible, but I don't think the contours of the rest of the year change that much. So I think what's been sort of created as big headwinds, the decision point is going to be if we avoid recession. And I think for a lot of reasons, I don't think the U.S. is actually going to be breaking into a contraction.
I feel like the bullish goalposts, though, have moved, and yet we still want to act as though nothing has really changed for the remainder of the year. I've got a Fed that's still going to be aggressive in trying to get a handle on inflation. I've got earnings which are already trending lower, which are undeniably going to be trending lower. Economy looks like it's slowing. How do I deal with all of that and suggest that stocks can still rise in that kind of an environment? Maybe they can, maybe you'll be right, but how?
Well, I mean, it's part of its perspective. I mean, oil surged, but at $100 a barrel, that's where we were 2014, for almost 4 or 5 years. And today, on a price per barrel, if you're paying $90 for oil, you're still paying like close to $200 for Diet Coke and $300 for bottled water. So oil's still pretty cheap, and as a burden, it's quite small. And in terms of the Fed the Fed not having a put because they have to tighten, I think it's really going to depend on the path of not only the war, but supply chain glitches. And I know it's a very difficult sort of period for the Fed to navigate, but I think our consensus is making a view the Fed's turned hawkish, and I don't think that's true. I think they're trying to find appropriate policy, but I do think consensus thinks they're so far behind they have to tighten to create a recession. So that's a really second sort of point of distinction. And the third is, I think there's been a lot of selling recently. I mean, of course, markets can fall for any reason, but I think we're forgetting that these sanctions against oligarchs, that's close to $300 billion of externally managed money that a lot of hedge funds now have to either freeze or redeem. And that's putting a lot of selling pressure on markets, and that's going to abate. So I think a lot of things that we're seeing that look like amplified downside pressure could be transitory.
Are you still suggesting, with a target of 5,100 for the year on the S&P, that our viewers today should continue to buy the dip? Because frankly, it hasn't worked at all, and they've been pummeled if they've done it.
Scott, number one, that for our clients of Fundstrat and FS Insight, we have warned them that the first half would be quite treacherous. So I don't think we've been advising buying the dip necessarily. We thought we'd end the first half flat. But for going forward, I don't think investors can get hurt. I mean, the risk reward is just too strong. I mean, I've heard a lot of the guests just cite this, but for instance, take consumer confidence. We're back to sort of the great GFC crisis lows for consumer confidence. And since 1978, if you look at 12-month forward returns from this decile of consumer confidence, the median returns close to 17% over the next 12 months. So again, this is more than double your expected return for owning stocks. So I think the risk reward, a lot of bad news is priced in, but again, it could get worse if we actually break into recession. But again, I think the stock market is pricing more than 50% chance. I think that's far higher than what credit is pricing.
Josh Brown, question for Tom Lee.
Hey, Tom, it's Josh. I want to make the point for the viewers that there's a difference between a cyclical bull market and a secular bull market, and then the same for bear markets. So the framework that I think I know myself, and a lot of people who understand market history have been working with is that the spring of 2013 was the start of a secular bull market. But within a secular bull market, you can tolerate several cyclical bear markets. They come and go. They tend to be less than 13 months in duration, and they don't disrupt the primary trend, which is expansion. Wouldn't it be possible this year for us to end up in a recession caused predominantly by higher prices, a lot of which recently is war related, but still be okay coming out of that? Like, would it be the end of the world to have the stock market go up 30%, 20% the year before, 30% the year before that, and then have a recession? Because for me, that seems like a reasonable conclusion to draw, that we're just going to have a little bit of digestion here. What's your take on that idea?
I agree. I mean, first of all, the Nasdaq's already in a bear market, and it's been nearly 6 months. So I think in some ways, if you had to say where was speculative excess already being tamped out, it's evident. The broader question is, will the S&P be taken down? But the difference is financials and energy. We like energy. It's still our number one sector pick. And if rates are rising and we don't have a recession, financials will hold up. So I think that what we need to watch is the NASDAQ bottoming. If it's bottoming, it's priced in this huge pain delivered. The sanctions are delivering a lot of pain to Americans. And the reality is the Fed going to amplify that pain by doing 7 hikes? And I almost think that if there's huge fiscal tightening already because of sanctions, I'd be surprised if the Fed follows through with 7 hikes. So you're correct. I think there's a bear market in the NASDAQ. It's cyclical. I just think in the second half, a lot of what we think are headwinds become tailwinds, and that's what helps the market recover.
Let me ask you a couple things before I let you go. I'm looking here, energy's up 28% year to date. You just reiterated the fact that it's your top sector. You don't think that the best gains are behind that space at this point? I mean, look, one day or two doesn't make a whole market, but I mean, oil is now, it's $97. It's down another 6% today. Those stocks are up so much. You really think that can continue?
I think oil is structurally going to rise, even though we know it may have an uncertain future. And that's because oil has become part of national security for many countries, which was not the case 2 years ago. Energy stocks were considered uninvestable in 2021. And in 2022, I think a lot of folks are just trying to get to equal weight exposure. But energy stocks are still cheap to oil. Even the OIH with this move is still pricing in maybe $70 oil. $90 oil means OIH could still double. So I think that profit taking makes a lot of sense. They're overbought. Our technician, Mark Newton, actually thinks, oil actually is going to rest here for a bit before making new highs. But I still like energy here.
All right, I'll make that the last word. Tom Lee, I always like the conversation. Appreciate you coming on The Half. We'll see you soon.
Yeah, thanks.